and welcome to this live programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment strategies. Today, we're talking to Iain McCombie, co-manager of the Baillie Gifford Managed Fund. My name is Amy Maxwell and I'm from Citywire, and I'll be talking to Iain about how he runs the fund for about 25 minutes. Hello, Iain. Welcome. Thanks for joining me today.
Good afternoon, Amy. Afternoon, everyone.
So it's obviously been a tough few years for growth investing, with the raising of interest rates making it a lot harder for businesses to operate. Is there still a case for growth investing in this climate?
Short answer is yes, but to take your first point, I mean, look, I know it's been a tough time for holders of the managed fund, and we're acutely aware of that, and obviously we want to do better in the future. And as a holder of the fund myself, you know, I'm very aware of that. But I think the key point is that this fund has been around since 1987. We've been through a lot of cycles over that period of time, but we stuck to our tried and tested way of investing, and that's not going to change. And you know, I'd love to kind of promise that there's going to be some magical way to turn it around, but actually the way we think we're going to turn it around is keep doing what we've done, what we've always done, which is to find great companies with above average growth prospects and to own them for a long period of time. And we think that what's happening at the moment, as you said, you know, inflation is high, interest rates are high, it's all a bit doom and gloom. But actually, if you get into the kind of into the portfolio itself, you look at the companies, you know, for example, if you look at the growth in our portfolio, we think it's about 60% higher than the market. So there's a lot of good things kind of going on there, which I think are not being appreciated by the market. But also, there are also pockets of kind of things that are doing really well, which the market is getting quite excited about. For example, in AI, where we've got holdings in that area like NVIDIA and other businesses that have performed very strongly. So the thing I would say, Amy, is it's not all doom and gloom at the moment.
And I suppose there might be some buying opportunities in some overlooked sectors.
Yeah, I mean, I'm sure we're going to talk about that later, individual stocks, but we're always looking for ideas. You know, what we're always trying to find are businesses which we think have got above average fundamentals over the next 5 or 10 years. And I think the thing I always say is that what is different about a growth business is that they're always trying to look around the corner for an area that people hadn't thought about in terms of growth. And there are a lot of our businesses like that. So from a bottom-up basis of the way we try to invest, there's a lot of optimism actually in the portfolio, despite all the kind of the doom and gloom you read about in the newspapers.
Okay, so this is the balanced fund. You take a balanced approach. So how does the new economic environment play into your asset allocation within the fund?
Yeah, well, in the managed fund, we keep it very simple. We have three asset classes: equities, bonds, and cash. Now, equities, I think, give us the growth, and the bonds and the cash give us the balance. Obviously, bonds give us nice income, and cash can give you some interest income now, but also gives you that option value for we can invest it if we think there are real opportunities elsewhere. So where are we positioned at the moment? Well, our standard position is to have 75% in equities. That's our kind of standard weighting. But actually, at the moment, we're a bit above that. We're about 78%. And that reflects our bottom-up conviction. We're not top-down. People may have heard that phrase. We do asset allocation in a different way. We do it bottom-up, which is where the individual managers that run the different regions get together. And what we're seeing is that the regional managers and the team, including myself, are finding individual ideas that are very exciting. Now, Stephen Hay, my co-manager in the managed fund, is also more optimistic about the bonds because the yield's been a bit more attractive. So actually, our bond position is just about neutral. So really, where we're underweight at the moment in terms of our target position is cash a little bit. Cash is about 2% at the moment. So that's the way we do it. But we're just keeping it very simple: equity, bonds, and cash. We think that's all you need to deliver good returns over the long term.
Okay, we talked about the an evolution in the investment climate. Let's talk about this time an internal evolution in the way in which you run the fund, because I understand from mid-November the fund is going to make its objectives towards net zero much more explicit. So can you give me a little bit more detail, and indeed our viewers a little bit more detail on that?
Sure. Well, I think the first thing to say, Amy, is that we're not changing the overall objective of the fund, which is to generate capital growth over the medium to long term. That's not changing. But we're also cognizant of that this fund has been running for a long time, but we also have to evolve it, and we have evolved it over time. And the one that you've exactly highlighted that we are proposing to change is to say that by 2050, we want the whole portfolio to be aligned to net zero. Now, people are probably wondering, well, what does that mean for the portfolio? What changes will come out of that? Well, the best way to explain that, Amy, is at the moment, if you tot up all the equity holdings in the fund and all the bond holdings, you come up to about 344 positions, which is also a very important point about it's a very well diversified portfolio. But when we adopt this change in mid-November, of those 344 names, we're going to have to sell one. Okay, so this is a very small change in the portfolio. Now, you might say, well, why is that? Well, again, as growth investors, we're forward thinking. We're trying to invest in businesses that are on I'd call the right side of history. We're already doing that. But so therefore, in terms of the portfolio, you're not going to see any real change at all. But we think it's very important because a lot of clients have been asking about this. That's what we're kind of nailing our colours to the mast. But I should say, Amy, that the real thing to me as an investor is not about the net zero target. It's about working with companies and encouraging companies. How do you get to net zero? And that's the really challenging and interesting thing at the moment.
So essentially, this was all already baked into the process, and
exactly.
It was just one position that didn't apply kind of with the spirit of net zero is not making
exactly.
great.
So 99.65 or something percent of the portfolio doesn't change at all.
Excellent. Okay. Well, let's stay on this topic of sustainability. Last time I spoke to you, it was a couple of years ago, actually, and you were very interested in a European heat pump manufacturer, NIB. I understand you've recently sold that holding. So can you tell me the backstory there?
Yeah, well, it's well remembered, Amy. I mean, again, it's a Swedish company that we've owned for a number of years. I think it illustrates really 2 points. One is sell discipline, which I'll kind of come on to in a second. And the second one is that a great company may not always be a great investment. And I think that's a really important point in general investing. So the first point really on self-discipline is that we're long-term holders. You know, our portfolio turnover in the fund is very low. But that doesn't mean that we're not looking at companies and having that discipline of saying, well, it may have been a good investment, but is it going to be a good investment in the future? You want to keep kicking the tire to make sure it still makes sense to own it. Now, NIB is a good example of that. It's been a fantastic investment for the fund and for the holders since we've owned it. The reason for that, as you said, it makes heat pumps. It's mostly in Europe. I know it's very controversial in this country, but really the growth is coming from Scandinavia and Northern Europe in particular. And that's been growing very strongly. And then because, you know, as you kind of hinted at that everyone loves a green stock, it's multiple, it's re-rated. So you had a great growth and you got a re-rating on the stock. So the share performed really well. And that's fantastic. But what you have to keep asking yourself is, well, that's a great company, but is it on a forward-looking basis going to be a great investment? And we could see some signs that although everyone loves it, there are some signs that there's a bit of competition coming in, which might, I think, impact margins. There's been some legislative changes in 1 or 2 markets, which perhaps might not make it as attractive. So we said, well, actually, although we like the company a lot, we like the management, we think a lot of the good news is now baked into the price, and we think it's the right time to sell. So even though it's a great company and it's very green, we think it's the right thing to sell, and that's what we've done.
Essentially became the greenest stock you could think of.
Pretty much, yeah.
So you did replace it with a similarly green stock, but less well known and based here in the UK, I understand.
Yeah, we didn't actually replace it. I wouldn't think about that. The way we try and think about it is we're trying to find individual investment ideas that make sense. And one company we've owned for actually a bit longer, for a few years now, is a company called Volution. Now you may not have heard of that name, but if you actually go into somebody's bathroom, you might see a brand called Ventaxi or National Ventilation or Manrose, and they are all Volution brands. So they make fans for bathrooms, but they also make clean air solutions for much bigger, for apartment blocks or for houses. And this is a fantastic business. It's a very cash generative business. It's growing. There's a lot of legislation that is pushing its way, and its rating is far lower than NIB. So I think it's still very, very attractive, and it's growing very well in internationally. About 50% of the business now is international. So it's a great UK business with great opportunities to grow in years to come, and it's one of the big players in this market.
Okay, excellent. I mean, we touched earlier there upon this idea of stock being hyped. I wanted to touch upon another one, Moderna. So thanks to the pandemic, of course, it had an incredible run. You're sticking with it, and you can see much longer term value here. So can you explain what is the evolving kind of investment case for Moderna?
Yeah, well, I think this is a classic example to me, Amy, of the short term against the long term, because as you said, they had a huge boost from the kind of the COVID vaccine, and obviously huge demand that came from governments to inoculate the population. So that was a huge windfall, and obviously they made a lot of money from that. Now that's obviously reversing now, because obviously governments are not kind of buying millions and millions of the vaccine. So therefore that part of the business is declining quite dramatically. And in the short term, the market doesn't like that. But actually, what we think is much more important is their technology, which is what's behind why the COVID vaccine was developed. This is mRNA technology. And before COVID hit, the company had a very interesting pipeline of drugs or using this technology. Now that got parked by the company when COVID hit, because they had to focus on this. This was the kind of the key thing to focus on. And I think we all look back on that and say, thank goodness they did. But I think longer term, what is exciting is they're now getting back to the, almost you call it the day job, of finding these using this technology to find novel solutions to big problems like cancer and things like that. And they've got 30 big drugs that are in the pipeline that they're developing at the moment. Now, I'm sure a lot of people know that this doesn't happen overnight. This takes time, it takes years. But the great news is that Moderna have about $15 billion of cash on their balance sheet, so they can fund this for a number of years. So actually, we still think the technology is very exciting. The data from some of these test trials of these some of these drugs being very promising. So it kind of really backs up, why the COVID vaccine worked so well, but also why we think it's got huge applications elsewhere in the world. So that's why we're sticking with it. You think long term, this company has got amazing opportunities for growth.
And I suppose that cash buffer you talk about, that $15 billion is really going to be pretty useful in a rising interest rate environment where many companies are struggling.
Yeah, I mean, I think for them, that's a kind of, I call it like a Brucey bonus, the fact you get some interest income, but it's not the real story there. But I think you're right. In terms of balance sheet strength, I think it's a really important point more generally. If you look at our portfolio in general, it's got much lower debt compared to, in terms of debt to equity compared to the market. So again, it's one of the things that we like about our growth businesses is, can they actually realize the potential of that growth? And to do that, you often have to have strong balance sheets, good free cash flow from the businesses, and that's really what we're doing. So there are a few names that perhaps might not be there, but most of them do, and that's really important to us. And it gives you that comfort when times are tougher, interest rates higher, and economic conditions are a bit trickier in the short term, that you can get through that. And I think that's really important for the long term.
And this idea of endurance runs through a number of the fund's other holdings, many of which our audience will probably be aware of. They're household names. So can you tell me a little bit about what's going on in M&S and Greggs?
Yeah, sure. Well, I think they're kind of good ones to talk about, Amy, because I think a lot of people think of Baillie Gifford as being it's all about technology or biotech and whizzy disruptive names. But actually what we've always said is there's all types of growth. We're very growth agnostic of where the growth comes from. And I think these two companies are interesting because particularly M&S, we bought it a couple of years ago, and we hadn't owned it for over 20 years before that. So this is quite a departure from us. And the reason for that is we could see a potential turnaround of the company, that the management team, we think, have done a really good job of addressing some of the issues. Obviously, they've got a great food business. They've now got a tie-up with Ocado for hopefully in the long run to solve the internet kind of food shopping area. But what is also interesting, and to our surprise, if I'm honest, Amy, is how well we think they're starting to turn around their traditional estate. And to give you an example of that, I was actually, we get out, we don't just sit in our office in Edinburgh and twiddle our thumbs and watch the world go by. I went down to Liverpool to see their new store there and to meet the chief executive. And that's a really interesting example, I think. And if people know Liverpool, they had a store in the centre of town, been there for over 100 years. Getting a bit tired, that's that area, bit more kind of, I think gritty would be the polite way of putting it. Now they've moved about 5 minutes away from that to the one shopping centre, but a very different part of town, to be frank. It's in the old Debenhams store. Now what's interesting is it's about 20% smaller than the old M&S store, but because it's been repurposed with the kind of what they think is what customers want, it's selling about 30% more since it opened compared to that. So 20% lower, smaller in terms of size, but 30% more sale, which is really quite exciting. And I think there are more stores. It's not just Liverpool. There are other stores like that where they can do that. And I think we can all think of stores in high streets as we're looking a little bit kind of down at heel. But I think they're working their way through these stores, moving them either to out of town or to a better location in the city centre, and they reap the benefits of that. And I think it's really exciting for me that I think M&S is starting to get its mojo back. It's not perfect yet. There's still a lot more to do, but there's lots of kind of interesting green shoots there.
It feels like it's being a lot more strategic, and there's a lot more optimization of the assets for which they hold.
There are a lot of interesting things going on. I mean, the management team have got a lot on their plate, and it's some people would say, well, yes, we've heard these types of stories before, but I think they really are grasping the nettle, and I think the kind of pandemic really forced them to kind of take some tough choices. And again, if you look at the food business, it's really performing strongly. They invested in price, which made them more competitive. A lot of people used to say, well, M&S is really expensive, and they've had a pleasant surprise when they've been coming in recently. And that's why basically Waitrose has been struggling, because M&S has basically been kicking their butt in the food area. But then, so I think that's really exciting. Now, you also asked about Greggs, which is a very different story. It's the kind of the high street or takeaway chain, food to go. And you can say, well, what's the growth story here? Well, I think what's interesting, there's two interesting things. One is that they have done a fantastic job of turning themselves away from being a bakery. That's what it used to be. It's basically a food to go store. So it's sandwiches and hot and food, and it's savory food or sweet food. It's great. But what's really exciting, and I think what people haven't really grasped yet, is what they're doing in the evenings. Now, people think about bakeries that you go there in the morning, or you maybe go there at lunchtime and buy kind of early afternoon, it all tails off. But what management have done for a couple of years with more confidence to say, well, actually, we've got these stores, we're paying rent in them. Why can't we use them a bit longer? Why can't we open in the evening? And they've been experimenting with different types of food there, and they're actually now finding success. And you may be amazed to hear that about 9% of Greggs sales now come in the evening. So, that's the thing. So it's not necessarily people eating vegan sausage rolls in the evening. I'm sure a few people do, but it's things like pizzas or chicken goujons, or as one of my colleagues said, that they're now addicted to kind of warm yum-yums. So, that's the sort of thing that's happening, which is really exciting for them. And I think still there's more to go for there. So I think it's a great growth story that's still been underpriced.
And again, it's sort of taking that early morning bakery model on its head and turning it on its head, and open all hours with a varied menu. So again, this theme of optimization, of sweating all the assets.
Exactly. And I think it's, we all know there's a big takeaway market in the evening, or, it's not as if this is a new market, but they said, well, look, why can't we be in this market? People love our product at lunchtime. Why can't you have a slice of pizza on the way home if you haven't got anything to eat, or why not? And I think that's really resonating with people. So, we're very excited about the opportunity there.
So this is Greggs. It's all about sort of exploiting new markets. I understand another holding, Auto Trader. This is in the business of it's doing some ingenious things to leverage its cornering of the second-hand car market. So can you tell us more what's going on here and what's exciting?
Yeah, well, it's a great example I said earlier about companies that are able to kind of look around the corner and find new areas for growth. So the core business of Auto Trader is kind of secondhand car listings, like you said, and it's great because for you as a consumer, let's say you want to get, you know, a green BMW Series 5. You know, you don't have to look in your neighborhood. You can look at pretty much across the whole country, and if you're prepared to travel, you can find that car. And that's great. It's great for you, but it's also great for the second-hand car dealer because therefore it expands their customer base that they perhaps didn't have in the past. But what Auto Trader have been doing is a couple of things. One is trying to say, well, what else can we do? You know, one of the things about second-hand car sales is finance. And they've been helping, you know, get people pre-approved for car finance. They get a small kind of cut of that, and again, it's not big, but it starts from nothing. So actually, that's quite attractive. But what also what you said, which is really interesting, is it's a new car market. Now, I'm sure everybody knows how the car market works in the UK. You know, there's car dealers. You go into a car dealer, whether it's in Edinburgh or down in London, you might get a different price depending on what the car salesman is feeling like, and so on, or how hard you bargain. But actually, what's really exciting at the moment is there's a big change happening that some people may not be aware of, is what Mercedes-Benz have started to do, and we think other brands are going to do this as well, is to say, actually, we're going to have one price. Mercedes are going to set the price for a new car across the whole of the country. So if you go into a showroom in down south, and I go to one in Edinburgh, we're going to get the same price. Now that is really quite interesting for something like Auto Trader, because then why can't you sell an Auto Trader? Because actually, if you're selling a car at the same price, why can't we do that? And I think the other thing I think is interesting is the power of brands, because I think the car brands think they have a tremendous brand themselves. So they think, you know, Mercedes, they think they have a wonderful brand. And I'm sure, you know, you and I and the audience would probably we all know what Mercedes-Benz is. But if you're buying a new car, do you only look at Mercedes because you like Mercedes? Of course you don't. You're probably going to look at other brands as well. You look at Mercedes, BMW, or Lexus, or, you know, Range Rover, and so on. And you're going to go to a site like Auto Trader that kind of gives you kind of reviews and kind of comments and compare and contrast. So actually, we think this model might actually be quite interesting for Auto Trader. I'm not saying necessarily it's going to be a huge market for them, but again, it starts virtually at zero. And that's what I like about this management team, is they're always looking for ways to build on their strengths and to make their site ever more relevant for people who are wanting to buy a car.
Okay. Well, I mean, it certainly seems like there's plenty of reasons to be optimistic about what's going on if within the portfolio. We're reaching the end of our interview time. I was going to turn to the audience. We've got some questions that have come in.
Sure.
Now this is quite a macro one. I know we've talked about how you're very kind of bottom up, but how likely is it that there will be a global recession over the next 2 years, and how might that affect your investment strategy? Okay.
Yeah. Well, I mean, the honest answer is I don't know.
You don't have a crystal ball.
No. That's not our game. We don't play that, you know, trying to kind of waste a lot of time, you know, trying to speculate on what's going to happen in terms of, you know, recessions and so on. Look, what we do know is interest rates going up is going to slow economies down, and that will have some pressure, and that's true. But look, we've been around since 1987. I don't know how many recessions or near recessions have been predicted. There's been far more recessions predicted than have actually been the case. You know, we just happened to see in the UK not that long ago, where basically they found another few £billion, you know, because the growth wasn't quite as bad as people had thought. And, you know, this is the sort of thing that why we don't spend a lot of time worrying about, you know, economic growth and so on. I think what we're trying to look at is, you know, what I said earlier about, you know, does the company have a good management team? Does it have a good balance sheet? Does it have good growth opportunities? And if it means there's a tough couple of years, well, that's not a bad thing. And sometimes actually, it's actually very good for good companies, because it's usually the weaker companies that struggle in tougher times, and actually that plays to the strengths of the businesses which we think are winners over the long term.
I mean, that plays nicely. There's been another question along the same lines, but given the fact that the world has changed over the last few years with wars, inflation, etc., why has the investment philosophy not adapted with it, sticking instead with it as always worked in the past? So, I mean, it feels like maybe we should emphasize, go into a little bit more detail around kind of maybe the opportunity to grab market share when times are, when the chips are down, I suppose.
Well, I mean, I think the thing first I would say is, and I don't mean it's a good question, but again, if I can give a robust answer to it, it's like, well, look, there's been wars and recessions and worries ever since this fund started in 1987. I mean, I could put up a chart that shows you every kind of crash and terrible war and unfortunately, whether we like it or not, these things happen far more frequently, and we forget about them and we just worry about the thing that's right in front of us. So I think in some respects, the bad news is there's always bad news. But the good news, I think, is that people never talk about the things that are working in the world and the good things and, the interesting things in terms of, what's happening in healthcare or AI, which we think are kind of creating opportunities for the companies that want to seek them. And, to my mind, just because you have the same philosophy doesn't mean that your portfolio doesn't change over time. So, for example, if you go back 20 years, we had a reasonable, 15% or something in energy stocks. We've now got virtually nothing and very little in energy stocks because we don't think the growth prospects are that attractive now as things have changed. And that's always going to happen. I'm sure the top 10 holdings in the portfolio in 10 years' time are going to look very different to what they are now because we're always looking for companies that have got the growth opportunity. And this is the beauty of capitalism, I think, Amy, is that markets change, and people are out there thinking about, well, how can I build a new business? And what is exciting for us is that the barriers to entry, I think, for growth are lower than they've ever been in a long time because of things like Amazon Web Services and so on. You can power a business much quicker than you could do historically, and I think that hasn't changed, and that's what we keep doing. So ultimately, what we're always looking for is above average growth from our portfolio companies. And what I would say is that that means that we are always evolving the portfolio. That's why the portfolio turnover is about 15% per annum roughly. There's always change coming. Some things don't work. You make mistakes, you move on from that. But equally, there are new opportunities coming in all the time, and I think that's the exciting thing about it.
I mean, that feels like the opposite approach to the suggestion that that you haven't changed the strategy. It feels like you are always assessing what makes it in.
Yeah, the framework is the same, but the way you look at it, is the business exciting? Can the management realize that potential? That business could change. Things become possible that weren't possible some years ago. Who would have seen the growth of things like Facebook or Amazon from very humble beginnings to be these giant companies. These are exciting things, and then the fact that the emergence of China into the world economy. What does that mean? And the opportunities there, or just the growth in Asia more generally. And I think there are lots of good things happening in the world as well as things to be worried about. And as one of my mentors kind of said a long time ago, why do you want to be a growth investor? And what he said to me, well, do you want to be part of it, or do you want to sit in the sidelines and watch it and not own it? And I think that, in the long term, even though it might sound a bit difficult at times, I think you want to be a part of it because in the long run, you should be an optimist. If you look at long-term returns for the stock market, you should be an optimist. And it's very easy to be a pessimist. You watch the news and listen to very articulate people telling you why you're all doomed. And I'm a Scotsman. I have to fight that. It's in our DNA to be kind of gloomy. But actually, it's the wrong way to think about it for investing.
And we've got another question here. How do you deal with correlation in the portfolio?
Yeah, it's a very, very important point. You want to make sure you've got proper diversification in the portfolio. So we have kind of internal guidelines to make sure that we're not too concentrated in certain areas. We also have an independent risk team that do quarterly risk reports, which are kind of looking at, well, the rules might say are okay, but are there any themes in the portfolio that we're looking at that are kind of correlated that might not look obvious, but that could be a situation there. So we're always trying to look at these things. but you can never guarantee it, Amy, because models don't always tell you everything. But we're doing as much as we can, and that's why we have a very well diversified portfolio. That say, unlike some Bailey Giffords, other strategies, it's not too concentrated. Our biggest holding is about, I guess, about 2.5% of the fund. It's not that concentrated. It's well spread. I think that's really important for our managed fund clients.
Okay, excellent. We've got quite a specific question here on what have the inflows and outflows been like over the last 12 months? I'm not sure if you have those figures to hand, but I suppose, how have you been managing the ebb and flow of funds?
Well, I mean, you put in the context, we had pretty strong inflows 18, 19, 20, and we've had outflows in the last 2.5 years. In terms of how you manage it, well, we manage it on a daily basis. We kind of look at our split to make sure that if say we have cash inflows or outflows, that we're making sure that the model portfolio the portfolio is kind of really targeted to our kind of target. I talked about our equity bonds cash weightings. We set that quarterly, and we want to make sure that we're staying in line with that. So if for example, you have some outflows, you may have to kind of trim your equity and bond positions to make sure that you stay within the agreed kind of limits. So that's how you manage it, both inflows and outflows.
Okay. We've got one viewer here he says, just finished reading an excellent history of Scottish American Investment Trust. What struck him was how many times that events dictated investment results. Do you agree or disagree?
I think it's true in the short run. It's a great question, and it's a great book if people haven't read it. I think clearly some events can be more important, and I think what I would say, Amy, is that the question doesn't always say is there are a lot of events that don't actually matter. But at the time, there are probably, you and I would be sort of sitting, talking in the studio, and this is the big worry of the moment. And actually, in the long run, people have forgotten all about them. So I think that's the kind of the tricky thing I would say about events. But again, that's why we take this long-term view, Amy, because I think if you get, pushed around by what's happening in the short term, you're not really thinking straight. It's very easy, I think, to be influenced by what's happening most recently. But actually, what we're trying to do as investors is step back and think about, where could this business be in 5 years' time, and why do you think it's going to be in that position? Now, we could be wrong on that. Obviously, that's the job. We're going to make mistakes on that, but we think over the long term that has set us up for why we have outperformed over that 30 plus years as a fund, because if you get blown around by events, you will, in the short run, that can help. But if you react to it, and I think that's the key thing, and what we're trying to say is that if you sell things because you're reacting to an event, that's disastrous, I think, for you, because you're not actually doing the right thing for the long term. And it comes back to one thing that we haven't really talked about, which I think is so important, and I think I've talked about it in good times, but certainly in bad times is really important too, is patience. And patience is so important in investment that it can be very frustrating when you haven't performed particularly well, and and it's very easy to get bored with stocks because they haven't performed, and it sounds very flashy for me to say, oh, well, Amy, I've sold all these things and I bought something new. But actually, the question you've got to keep asking yourself is, well, actually, if the business is still doing well fundamentally, why would you want to sell it, even though the market is not rating it very well? And I think that's the thing that we keep looking at. In a lot of our growth businesses, the market doesn't like growth businesses at the moment. We understand why, but that doesn't mean that we should sell them, because actually they are still growing, and we think they're getting stronger positions. And we're being patient because we think in the long run share prices follow fundamentals. So if we think the fundamentals are still on track, I'm not going to sell them. And maybe that's not what people want to hear, but I do think that's the best way for why this fund is going to generate capital growth, both in the past and in the future.
It's about that conviction as well, isn't it, to the long term? So do you want to expand on that, and maybe where are some of your highest conviction areas of sectors or geographies that you have for the next kind of
Yeah, well, I think that the really important point is if you look at the team that's running the fund, it's not just Steve and myself, the other regional manager as well. I mean, the average experience is about 20 years. So, we've been through ups and downs. And I think what we're doing, Amy, is rather than picking out individual themes, is we're still finding good growth businesses. And actually, a lot of them we own. So actually, our portfolio turnover has been relatively low because we're not sort of panicking out of things. I think in the US, for example, we sold a few of our lower conviction ideas because they just haven't quite worked out. But we've been adding to things that we do like, and then when we bought back into Meta, the Facebook, because I think actually what they've done has been pretty impressive. They're trying to address some of their cost issues. I think it's really good. So actually, the shape of the portfolio hasn't really changed very much. It's still got a fundamental growth bias, but as I said to you before, we've got a mixture of both kind of high tech, snazzy kind of new names like Moderna, but also kind of things like Greg's, which is kind of more prosaic. But what they both have in common is we think they're growth businesses, and that's what we can continue to keep doing, and we're not going to change that because we think that's the thing that's going to generate good returns over the long term for holders.
Okay. Another question here. Could you define, the target market of the managed fund? Would it still fit in a long-term decumulation aim? Okay.
Yeah, I know that's probably getting into advice, which I'm not sure I'm really well. But we haven't changed. What we're trying to do is generate capital growth over the medium to long term. So we're not trying to run this business on a short-term basis. So we're not trying to run it for a 1 year, 2 year. What we're trying to say is, can we generate capital growth over the medium term? And I think that's a really important aim for a managed fund investor because, income is good, but ultimately, you've got to, if you're going to use that capital in the future, you want to have more capital because income doesn't sort the problem. You've got no capital after the income's run out. And that's why we've always focused on capital rather than income growth, because we think that's the thing that matters over the long run. But when it comes to deaccumulation, that's I'm afraid I'd say speak to an advisor, please, not to me. They'd give you much better advice than I can.
Okay. Could we have another viewer here who's looking for a little bit more info on your rebalancing strategy?
Sorry,
on the rebalancing strategy.
Well, I think what I mean is what we do is we have every quarter we have a policy setting meeting where a number of senior people on the fund, including myself and Stephen, plus a member of our diversified growth team, who are meeting to discuss our asset allocation. So we're always looking at this equity bonds cash split every quarter, and sometimes intra-meeting as well, depending what's happening. But I wouldn't stress that this is the most important thing, because actually if you look at our returns over the long run, our outperformance, I think 85 to 90% of it's come from our stock picking. So actually our asset allocation doesn't change a huge amount because we don't think we actually had enormous amounts of value from our asset allocation change. But we're just kind of trying to check, convictions. And it's also very good from that bottom-up basis to see, well, where are people's convictions? And, to give you an example, it's one of them I'm sure I've used with you before, Amy, is that, going into the great financial crisis, our cash levels were quite high, not because we were predicting the crash, it's because at that point, on a bottom-up basis, people were giving money back, saying, look, I can't find any ideas, I can sell ideas, and, we should give us the money back. But what's interesting at the moment is we're seeing the opposite, that where people are saying, I really believe in this portfolio and I'm finding opportunities, I want to have some more cash. And that's why we're above our target weight. So we're always kind of, checking, does that make sense? And that's been one of the kind of key debates, I guess, within the policy setting group is, we're still very positive about equities. Does that still make sense? And, it comes back to this conviction. I've got colleagues that have been very experienced, very good stock pickers, and they're feeling really excited about their portfolio. I'm feeling really excited about the UK portfolio, and that's why we've got about 78% of the portfolio in equities at the moment.
Excellent. Okay, I was wondering how long this one would take to come up. How has your view on opportunities in China changed, or does that fall into the event category?
Well, no, I mean, I don't think it's the event category. I think it's kind of always a discussion about, you know, there's two things. There's direct holdings and there's indirect exposure to China. I think that's very important. Our direct exposure actually isn't that big. It's about, 4 or 5%, something like that. Maybe less than that actually. But our indirect exposure, when you look at, say Western companies that are selling into China, is obviously bigger than that. And that's not a bad thing because, China is the second biggest economy in the world. It's growing despite some kind of challenges at the moment. But I think, to us, it's never been a big position for us in that respect. So I think our emerging markets team have always tried a very pragmatic view there. I think you want to be on the right side of where the government is trying to encourage investment and so on. So I think we've been more on the domestic exposure and things like that, which I think is obviously still a very important point, for China. So that's the way we're trying to think about it. The trickier one, I guess, is just what does it mean for supply chains over the long term? And I think it's not just China. I think COVID has been a real eye-opener for a lot of companies in terms of just, what's the supply chain? Is it too thin? Do you need to kind of take stuff back, I think. But actually, it's not always the case. There's a lot of companies I speak to, for example, Mexico is benefiting. If you're going to be in the US, you're not necessarily going to go out to the US, but you're going to go into Mexico. So they've moved stuff from Asia back into Mexico. But equally, there's a lot of companies in Asia that are doing really well. And I don't want to kind of sound negative on Asia. I think there's a really long-term exciting growth story in Asia, which China is part, but it's not the whole story.
Okay. And in the last few minutes, we have a final question. What are your thoughts on capacity within the portfolio?
Plenty of capacity.
Sorry, I didn't.
But plenty of capacity. Yeah,
plenty of capacity.
Yeah.
Right, perfect. Okay, well, I think that is a great way to end an opportunity. Thank you very much, Iain, for sharing everything. It certainly feels like there is plenty to be optimistic about in growth investing, despite the headlines.
Yeah, agreed. Thank you.
Okay. That's all we've got time for, I'm afraid. So thank you again, Iain, for your time and insights. And thank you all for watching and for your questions. We have more sessions like this coming up, so do keep an eye out for those if you found today useful. That's it. Thank you very much.